Well, hi, my name is Kavita May. For those who don't know me, welcome to our installment of the channel chat series that we do with our data providers IDC. Welcome. We started this series almost a year ago. I think it was April of last year. So we're nearing the 12-month anniversary here, guys. So just wanted to welcome everyone. We will have some of this available on our website post. We'll send you guys information on that. But without further ado, let me go ahead and introduce Frank Vitagliano, who will kick us off.
Hey, Kavita, thank you. And good afternoon, everybody, and good morning. Yes. So yeah, we're excited because we've been, now this is, I think, our probably third, Lauren, third or fourth even.
I believe.
Webinar where we're going to provide you information on what's happening in the marketplace. So if you go to the next slide, today, what we'll do is the three speakers will be Lauren, who's the VP for Data and Analytics at IDC. And we've got Lynn, who has responsibility for consumer devices. And we'll talk specifically about the overall market. Lauren will do that. And then the consumer device piece, Lynn will take us through. Before that, and I won't take very long, but I want to mention two things. Yes, we recently released at our North America Summit a distribution economic impact guide. And for those of you that are in the vendor community, I think you'll find this really interesting because it provides you with an overview of the costs and the offsets of distribution relationships. So I know that's a discussion that, I've had many times with many channel chiefs. And I had it with myself for lots of years when I was a channel chief on how do we quantify the value of distribution. And there's a lot of, underlying value that sometimes gets overlooked. And this guide will provide you with a way of looking at it and be able to really help you articulate the value and the ROI and the investment in distribution. So that's one thing. It's available on our Knowledge Hub, gtdc.org Knowledge Hub. You can kind of see the URL down there. And then if you go to the next slide, I mentioned we just finished the North America event. We've got our European event coming. For those of you with global responsibility, we hope to see you in June in Amsterdam. All the details are also on our website, but registration is open, and we're looking forward to seeing as many of you as we can. So with that, Lauren, I'm going to turn it over to you.
All right. Thank you, Frank. Thank you, Kavita. And thank you, everybody, for joining. Frank kind of went over the agenda. We'll start with some macro context and then get into the NADT results. And Lynn will finish up with some insights on consumer device trends. So let me get right to it. So I think, the macro environment always sets the context. And there's been a lot going on lately, a lot of common themes. But the way that we've framed this, the way we're talking about it in our forecast discussions is roughly the following: that inflation is really one of the dominant factors right now. It's driving the economic cycle. And although we've come down from recent peak, we're coming down slower than everybody wants. So we're down in the US to 6.4. It was a minor, just a 0.1% decline. Shortly after, we got new unemployment and retail spending numbers, which were stronger than expected. And it's a little counterintuitive. That suggests actually that the economy is kind of overheated and we're more likely to have higher interest rates for longer and potentially lead to a larger downturn. So trying to find that, sweet spot Goldilocks scenario, but it seems like inflation is being a little too persistent. Although we're focusing here on North America results, I am highlighting the some major inflation numbers around the world. So Asian economies continue to be running a lot cooler. It has a lot to do with China's slowdown and actually Japan's years of slow inflation. The euro area with just their environment, but also the Ukraine war is having higher inflation. So where all the economies are linked, of course. So, I think it all fits into the puzzle. Similarly, the GDP outlook, we're seeing greater concerns and slower growth within the Americas and Europe. That said, a lot of emerging regions are dependent on the major economies. So if it's US and Europe, that has a big impact. Also China, Japan, Canada, and so on. And of course, we've had the ongoing Ukraine war and the recent earthquake in Turkey and Syria, which is disrupting the region. The war in Ukraine, now we're in the second year. Doesn't seem like it's going to end anytime soon. It's had a major disruption to the local area, but it's also reshuffling global politics and relationship, economic roots. There's so many impacts to this. A couple of months ago, we were highlighting the risks to energy and food distribution globally. So I didn't phrase this the best way, saying the worst impacts, because the worst impacts are clearly on the livelihoods of the folks in Ukraine. But relating to the energy and food distribution, there's a silver lining that it wasn't as bad as could have been. There's still a lot to unfold regarding that situation. Similarly, China, of course, is a major, economy and political player. On the economic front, their end to strict lockdowns has kind of boosted the region. Growth seems to be fairly solid, but there's questions about whether that's inflated or will continue. So some uncertainty there. And then just in the diplomacy and international relations area, continues to be a fragile situation with the recent spy balloons and ongoing issues with Ukraine and Russia and Taiwan and so on. Again, it's a risk of disruption and just uncertainty in travel and even tax regimes and so on. Finally, kind of back to logistics and IT. So the supply shortages that came about as a result of the pandemic have mostly been addressed, mostly, unfortunately, by slowing demand. We'll talk a little bit about how that's playing out, where, over the past couple of years, we had many quarters of short supply, and now as demand slows, the channel's readjusting, and we're getting to some cases of even oversupply. From the demand side, throughout 2022, demand was fairly strong across the board, but we did see some weakness shifting from consumer into enterprise later in the year, and it's certainly not immune to slowing economy. So, the general theme is risks and slowdown, which should come as no surprise, but hopefully it's helpful to kind of talk about and think through each of these factors. So from there, I'd like to share some numbers. Start with the US inflation rate. This is, inflation is year-on-year change in the consumer price index. And while it's come down in the most recent January reading, it only came down a minimal amount. And the blue circle there is highlighting the year-ago inflation rate. That's a pretty high rate. You could expect normally that with a high rate last year that we would have had a lower rate this year, and it didn't really pan out that way. So as a way to conceptualize that, I've added the cumulative price change in orange here, and you can see that while we had 5 or 6 months, but actually 7 months there of relatively stable cumulative impact, with the January result, we're actually up significantly. So again, this all points to the persistence of inflation and the consequences in terms of interest rates and potentially slower economic growth going forward, the cost of fighting inflation. Then I also wanted to highlight some of the components of inflation and how they're changing. So over the prior year, gasoline was by far the biggest impact on inflation, and that's now come down to nearly zero. So it's a good example of the year-on-year change impact. In 2020, you had this dramatic drop, 2021 and 22, a rebound. And, you know, it's not just year-over-year changes, but that gas inflation is actually now down to near zero. But in its place, we've got other persistent factors. So food and electricity, natural gas are all up double digits. Shelter is a really big expense, and that is not slowing down yet. So, you know, lots of elements to inflation, and it's persistent generally. Despite those challenges, this is a long history of global IT spending growth versus GDP growth. And with only a few exceptions, in the dot-com bust and the financial crisis, did IT spending lag behind GDP growth. So, you know, even though we're entering, or we're in a period of risk for economic growth, we're fairly confident that IT spending is going to remain above that. You can see in the dashed lines the change from the prior forecast. It really hasn't changed all that much. Another trend or feature of the transition in the market, again, this is global Black Book spending, global IT spending in our Black Book, is that consumer had the biggest bounce and recovery in 2021 with a big impact from PCs and consumer devices. That's basically flat now, and it's been coming down, particularly PCs. In contrast, enterprise and services have been more robust and have a more stable outlook. In parallel with that, most of the growth is coming from the enterprise growth is coming from the cloud side, so newer technologies, and the traditional infrastructure is not doing quite as well. So anyway, hopefully useful context on the market environment that we're going into. So with that under our belts, let's shift gears and take a look at the most recent NADT results. I've shifted approach this cycle a little bit. I'm focusing on rolling 4-week data. And this allows us to get a very current view of the market. So that all the data, I believe, that I'm presenting here on NADT is through February 12th. So just a couple of weeks old. So let's start with a view of actual actual weekly data. So you can, I've shown this in the past, and you can see there's a lot of volatility, both in the revenue volume in blue, as well as the year-on-year growth in orange. I've added a trend line, which you can see is clearly trending down. You can also see that the volatility in the market, the variation between top and bottom growth rates has slowed dramatically in 2022 and 2023. Actually, most of the growth through 2022 was positive. It's not that there weren't any negative periods, but the large majority, you can see a couple of outliers there were, the large majority were positive, a couple outliers were negative. But as we shift into 2023, out of the 6 weeks that we've got, 5 of them are negative year on year. So the lows in terms of growth are not particularly low. You can see that we actually had some lower growth rates in 2021, but they're not being offset by the higher growth and with the frequency that we saw in the past year or two. So let's now compare that to a rolling 4-week view, which is a good proxy for monthly data. It's actually even more normalized, of course, I mentioned, because 4 weeks are always 7 days, whereas months are not always 30 days. or 28 days as the current case, or as February. But anyway, you can see the trend line is mostly similar. If you look at the blue revenue line, you can see fairly clearly that there's a fairly stable growth through 2022, as opposed to the rising trend in 2021. And I think it's interesting to note that as growth was slowing in 2022, it's actually because the comparisons were getting more difficult. So, Q4 2021 was much stronger than Q1, whereas if you look at the 2022 results, they're actually fairly stable. And I like that because it means the past year was stable as opposed to declining. You could get similar growth trend if you had a stable 2021 and a declining 2022, which would be less desirable trend for right now. So anyway, not bad, but we are clearly trending down in 2023. And the first 6 weeks are down about 13% versus 2022. So back to pre-pandemic levels. Okay, so as in the past, I've also looked at this on a 2-year average view. And the point of this is to kind of balance shocks to the market like COVID. So if you have a crash and a rebound, averaging the 2 years kind of offsets that. Similarly, if you have a boom and then a bust, or a shifting of demand forward or backward, then this is a technique to kind of review that. So, the most striking difference here is that 2023 remains positive. You can see in the dashed green trend line that, we have to acknowledge that that's because 2022 is lifting the trend, but it does represent a much more stable overall trend. It is worth noting that the scale here, I've kept it consistent from weekly so that the size of the visual is the same, but getting up to 100% is fairly large. And so even the peak of this trend is still in double digits. And keep that in mind for some of the other slides coming up where they're on, the scale is either locked or the same, but anyway, you want to watch that to get the right perspective. Okay, so the peak rebound was around week 17 in 2022. So early Q2, that was actually a while ago in this view. You can also see the end of quarter peaks that really stand out in 2022. So those on the right-hand side of the graph, those top skinny blue lines, those basically are the last week or so of the quarter, where we had strong growth in both 21 and 22. And so, those are closing out quarters. And then I mentioned the growth ranges, which were much more variable in the weekly view. And here, when you're looking at the combined view, you can see that in most cases, they're balancing out. And so you've got a much more stable view. This kind of represents, I think, the actual growth rate with some of the noise removed. All right, and then here's the same 2-year average, but applied to rolling 4 weeks instead of individual weeks. In this case, we've got the peak rebound around week 18, so essentially the same, but it was a bit broader. So lasted most of Q2. You can see the overall trend is still positive, and a lot of the volatility, I guess, is, don't guess, you can see right there is normalized and reduced in this view. Looking at US versus Canada, we have an interesting story here. So the first thing to point out is that Canada is declining faster than the US, the far right of each of these charts. Let me also just point out what these are. So on the left, we have just the straight rolling 4-week revenue view, so proxy for monthly. In the middle, we have the 2-year average rolling 4-week, US versus Canada in both of those cases. And on the right, we have Canada only, but comparing consumer devices versus more enterprise-focused software services and infrastructure. And so You can see that, actually, I reversed the order of these slides. The next one will show you US by segment, but the orange line here is showing the resiliency relative for software services and infrastructure, whereas the devices view has come down quite a bit. That's what's pulling down the forecast. The other thing to note in terms of the different phasing, and I've pointed this out before, is Canada reacted or had a much quicker growth and recovery to COVID shutdowns than the US did. And while that's good, it meant that the last 2 years were not quite as strong. And you would think that would, an easy comparison from 2022 would set them up for higher growth in 2023. And we're not really seeing that. So I think that's an interesting indicator of essentially weakness in the Canada trend. So something to keep in mind. If you look at the middle chart with the combined view, the trends are a bit more aligned, but Canada's definitely growing slower. So, all right, next slide. As I mentioned, we're going to look at each of the technologies, and you can see a little bit how consumer devices versus enterprise have different trends. So what I've done here is the more consumer-focused products are in dashed lines. On the left, you've got the straight rolling 4-week view. The bottom line is PCs, personal computing, generally, not just PCs, but thin clients and the other computing, personal computing elements in there, and pretty dramatic decline going into the new year. The other ones to point out, light blue, which is at the top, but slowing, is AV and consumer electronics. And the others category includes peripherals and imaging and some other categories. That was fairly stable for the last 2 years, but definitely turned down in the new year. And in contrast, the solid lines, yellow and orange and gray, infrastructure, software, and services, those are fairly stable, with software actually ticking up at the end. So, so major things. So next view is, again, the 2-year average. The most notable thing is that PCs is really the only one of these trends that's clearly going negative. AV and consumer electronics look like they're close to a bottom. So consumer electronics is still kind of on the way down, but that's the light blue line. The green dashed line for other products is actually already starting to tick up in the new year. So, in terms of underlying trend, I think, again, this is a useful view. You do want to look at what the impact is on month to month and what it means for actual 2023 shipments. But I think, throughout this recovery, when we see declining shipments, we want to put them in the right context and realize that, okay, we just had a bust, and with COVID, a boom recovery with a lot of investment and recovery. And so if we come down from that, it's rebalancing of the market, let's say. Okay. And in this view, software services and infrastructure appear even stronger. So strength of enterprise. All right. So hopefully useful perspective. I'm going to touch on a couple of technologies, software and services, and then we'll get into, Lynn will cover the consumer devices. Interestingly, in recent quarters, personal computing was the largest category. Turns out that because of the slowdown in PCs, software and services have actually passed it for this month. So the order is actually in descending order of size here. So software growth remains positive and increasing. Generally speaking, it's been a lot less impacted by economic slowdowns recently. There's a shift into cloud, as folks know, as well as to recurring revenue and as a service models. Those two things are driving investment and stabilizing growth. So, positive outlook for software. If we look at the overall market from our software tracker data, we're looking at better than 15% growth in all of 2022 in North America, and that's increased from better than 13%. Having said that, the growth is heavily weighted towards public cloud, which was up about more than 24% versus just 5% for on-prem software. And if we look at distribution revenue for software, it's more comparable to that on-prem segment. So that was up 8%. It's nice that it's ahead of the market, but still single digits, not getting into the double-digit range. So that low participation in public cloud is a significant threat for distribution software sales. The extent to which you can participate in that represents an opportunity. On the other hand, applications are the largest category for distributor software sales, and they represent just 16% of software sales for distributors versus 50% in the overall market. So, that's, again, an opportunity where distribution sales can expand and take advantage of a larger market. Okay, services are also benefiting from recurring revenue. There's a shift to subscription models, and this is shifting from spending from CapEx to OpEx and smoothing out revenue. You can see the orange trend line shows, clear recovery through the pandemic and minimal decline going forward. We are slightly below double digits, but trending in the right direction. One of the things that's happening here is that as the economy slows and companies and individuals become more conservative with their investment, there's a motivation to fix things rather than to buy new, and to delay new product purchases, lengthen the life cycle of existing products. All of that leads to additional services spending on warranty and maintenance and so on. So we have three main categories of services in the NADT data. Warranties are the smallest, but they had the fastest growth. They piggybacked on hardware sales and had the strongest growth. Support services were about half of the revenue. They grew the slowest, but still positive throughout. And then other services saw strong growth kind of in the middle during 2021 and 22. They're showing the fastest growth in 2023 as standard support and warranty services slow with the economy and with slowing hardware sales. So anyway, overall theme is distribution revenues are doing quite well despite all the challenges. The devices segment is showing some weakness, particularly in PCs, where software services and infrastructure are doing better. So, okay, that is my portion. I'm going to pass the mic to Lynn.
Thank you very much, Lauren. Always fun to be booked as a guest speaker when the market is sort of jogging in quicksand, as Lauren has expertly set up. So yeah, what we're looking at, I'm going to broaden this a bit. I'll step in and look at North American distribution because I know that's sort of the subject at hand. But I wanted to start broad and effectively show you what we're looking at. So this is essentially all IDC data of PCs, desktop notebooks plus tablets, rolling 4 quarters, as we were looking at before, in terms of unit millions. And as you can see, we sort of hit a peak around 2012 and 2013, and then it's been downhill ever since. Then the pandemic lands, and we shoot back up towards the peak of where the market basically had its max, about a decade ago. And since then, like has been reflected in the NADT data that Lauren has been talking about, we are seeing a quick downturn of the market, as you see very, very far right, skiing downhill at this point. Now, I do want to be clear, when we're looking at rolling 4 quarters, we're still above pre-pandemic levels. When we break it down quarterly, some of the quarterlies have hit, sort of 2019 levels. And I'll talk about this a little bit in the future. It's sort of bad news because, we're sort of soaring as a market, we're crashing down to pre-pandemic levels. However, long-term view, I think the good news from our perspective is, yes, the floor of this new market, when we crash to the floor, it will be below pre-pandemic levels. But as we grow and move more towards a steady state in future time periods, we will remain well above pre-pandemic levels. Next slide, please, Lauren.
Oh, sorry.
So this is the North American distribution view of PCs. We're talking about it broadly. And you could see the channel here is not immune, right? There's been a significant downturn of PC sales and tablet sales within North American channel and elsewhere as well in the last several quarters. Saturation has a lot to do with it. Very, very tough comparisons have a lot to do with that as well. We've gone 20 plus consecutive weeks of annual decline. You notice on the very far right, we do see some sales picking up after holiday closures, but still below the water level that was set over the last 2 years. We are hearing about at least one major OEM that is sort of reshuffling its channel strategy, and that's also affecting some volume here as well. We sort of believe that to be a temporary respite, if you will, that eventually distribution and the rest of the channel will backfill for that brand sort of maneuvering in the channel in ways to get inventory out of distribution. From an inventory level perspective, on the distribution side, we're generally hearing that if we're not at the upper bounds of healthy, we're sort of plus 1 week of healthy. This is not the case necessarily on retail, where we're hearing +2 to +3 weeks of healthy. But at least on the distribution side, it feels like inventory is still in a very manageable level. However, the bad news is, based on our conversations throughout the channel, it appears that a good chunk of the reason why inventory is still manageable and not blowing up to 12, 15 weeks, as we're seeing in EMEA, for example, the reason it hasn't been ballooning here is because they've actually severely reduced down inventory intake, which again was reflected in the prior slide showing ship-in volumes declining heavily globally. So all in all, business continues to slow. I think the good news is that inventory is much more manageable here than we are hearing in other geos. But the bad news on that front, again, is it's coming because of a slowdown of inventory purchasing and not necessarily because sell-through is picking up in sufficiently meaningful ways. Next slide, please, Lauren. Okay, so I think this slide to me is more indicative of what's going on in the market right now. The prior slides were talking about volume, and of course, volume is very important to market performance. But we always knew that the volume was going to start sliding at some point. I mean, that's what happens when you're growing 50, 60% in a quarter year over year, driving record growth. Eventually, we were going to hit saturation. Eventually, tough comparisons would land and the market would start to fall, and we're seeing that. However, what I think is more concerning to me is around price regression. So what you're looking at is price band data for desktop, notebook, tablet, all of that lumped together. I haven't broken out the legend because it really isn't all that important to discern, what's $100 versus what's $200. The important thing to note here is that the lighter shade on the bottom means cheaper price bands. I think the lightest color on the bottom is $100 or less. $250 or less. The darker the colors up top, that means the more expensive the system was. And so the darkest color we have at top represents the $1,500 plus price band. I've also broken out where the $500, where the market starts at $500 and then where it reaches up to at $1,000. And then of course the orange line is ASP of the entire market. And what I wanted to show you is, of course, ASPs since 2016 have tended to rise over time. 2010 to 2015, that was a really difficult time for the PC market. That was because volume was declining and ASPs were declining pretty rapidly. The practical way of thinking about that is that was a lot of the time when people were talking about good enough, right? Like, let's just keep buying cheaper and cheaper until we find something that's good enough. 2016, we saw that trend reverse. I think the big thing there was that's around the time we started hearing about millennials entering the labor force in more meaningful droves. And of course, they were not going to be happy with subpar technology being deployed to them. So around 2016, you could see the ASP steadily climb, but there's a seasonal mix to that, right? It goes up, it goes down, it goes up, it goes down. Then we hit the pandemic, and there's, I think, 7 consecutive quarters where the ASP just keeps climbing and climbing and climbing and climbing. The first 2 quarters of 2020, or sorry, Q2, Q3, where the ASPs go down, that has a lot to do with Chromebooks gaining a lot in share because of how hot the US K-12 market was for Chromebooks. But if you remove them, the ASP climb on Windows and Mac and iOS and Android itself goes back even another quarter further than what you're seeing right now. Now, again, we see a number of quarters of consecutive ASP increase, and it's pretty aggressive, right? We go from about $620 in the middle of 2020 up to $750 by the time we get into 2022. A lot of this was enabled because of shortages, right? Not only were component and logistics costs going up around this time, not only was there labor shortage, both in China and in the supply chain, that was driving costs up as well. But because of shortages, device manufacturers were able to negotiate their product mix a lot better than in an environment of surplus, for example. Practically speaking, that meant more workstations, more gaming systems, more high-end stuff than the market typically would take. And you see the ASP increase significantly. All of a sudden, around the end of last year, or midway point of last year, I should say, we're no longer in a shortage. In fact, in many geos, we're very much in surplus, and you can see the ASP start coming down pretty hard. Now, this is what I think is more indicative of the market struggles than the declining volume. It's the fact that we can no longer carry that aggressive ASP growth. It's the fact that it's already starting to regress in meaningful ways. This, to me, tells me that the market is settling down from that nice honeymoon period we got as a result of the pandemic rush. Last thing I'll say about this is I do think even though ASPs are pressured to come down throughout this year, in the long haul, it'll still be net up because people are buying better systems with each generation. And I still believe it'll be far above what it was prior to the pandemic. So pandemic buying rush in the long haul will have had a net positive on ASPs overall. Next slide, please. Really quickly, this is just our forecast for those same things, shipping and worldwide, I should say. This is for desktops, notebooks, and tablets. As you can see, I won't dwell on this too much. The important thing to note is that if you cut across all of 23, it's basically all 4 quarters we have negative growth. Now, we do have the growth rate returning back towards positive in 24, but you also have to keep in mind that in the back half of 23, those quarters are taking favorable comparisons from a growth perspective. And so the fact that they're negative on a very favorable comparison should tell you how soft we think the market is going to be throughout the remainder of the year. 24, we think things will stabilize, but again, it's sort of a flattish stabilization. So most of the growth we have reserved in the years out after that. So if you go and go to the next slide. So I actually was raised in a household. I know it's not couth anymore to think this way, but I was raised, if you've got nothing nice to say, don't say it. And for 2023, that's effectively the extent of what I have to say, right? I think everybody on board knows that this is going to be a tough year to hunker down. And so what I wanted to do instead was to focus on all of the good things that I'm thinking about that are basically right at the precipice after we cross this giant void that we're going to call 2023. So the 3 things that I want to talk to you today about are 1, next major refresh cycle, 2, Windows migration, and 3, technical workloads. And I think that's going to have a very positive effect on ASPs. Next slide, please, Lauren. So in terms of the next major refresh cycle, this is a view of what the market looked like in the year prior to the pandemic with those two pandemic-laden buying rush years, and then the market ever since. We're forecasted out to 27, but this view shows you to 2024. And it's broken by desktop in blue, notebook in teal, and tablet in green. The reason I'm showing you this is we think about that pandemic buying rush, that peak around 2020 and 2021. We think about all the units that were shipped and deployed at that particular time. And we think about, those units will become due for refresh at some point, right? I'm showing you composite US consumer survey data that we got at the end of last year. Sorry, not consumer, just composite survey data about device refresh rates that we got last year. And, for desktops, it's about 4 years, 5 months. For notebooks, it's about 4 years. And for tablets, it's about 3 years and 10 months. So we think about all those devices that were deployed during that rush. Those are going to become due for refresh in the ensuing years. Next slide, please. Now, it's not all that simple, and it's not all that great news. Obviously, this is contingent upon economic recovery. We asked, this is US companies, but I believe this data also tracks geographically. We asked IT decision makers, we said, hey, in 2008, we noticed a lot of trends that basically happened as a result of the last recession. Do you think these trends will affect your company? And what you're looking at is the results for extending hardware life cycles, which was a huge part of 08, 09, 2010, and why the market suffered so much from 10 to 15. It's because people just decided to own hardware, squeeze as much juice out of them as they possibly could. And when we asked IT decision makers at the end of last year in October, do you think your company will start extending hardware life cycles? Over a third said yes, whether we're going to do this purposefully or whether it'll happen accidentally. And about another half are considering it. So, even though we have the rush starting in 20 lifetimes in that 3 to 4 year range, it could push off another year because of the economy. But just know that whenever economic recovery does happen, we feel like there's a huge major refresh cycle that'll hit upon at the same time. Next slide, please. And even if the economy is still sort of jogging in quicksand at the end of the year, we think Windows 11 migration is going to jumpstart the commercial market no matter what. Now, it obviously will be much more muted, but by the time we get to the end of the year, we will have enterprises that no matter how the economy is responding, they will have to start purposefully thinking about migrating old Windows 10 systems to 11. If they want to meet the October 2025 deadline that Microsoft has set. We have gotten no inkling so far that Microsoft is thinking about extending that the way that they extended the EOS of 7 a number of times. And so again, you think about the EOS date, typically 18 to 24 months out is when the late majority really starts to pick up. The survey data you're looking at October of last year, so the end of last year, only 16% of the US installed base estimate had moved to 11. So there's a lot of runway left. The deadline is, in 25, and it takes a while for enterprises to move. We think when we get to the end of this year and into 24, no matter how the economy is responding, there's going to be positive Windows migration energy. Next slide, please. So my last sort of bullet point, I'm going to use technical workloads as a proxy for just high end of the market. So if you're not sort of super interested in these technologies, just think about this as a proxy for a conversation about premium technologies. But what you're looking at are essentially two different forecasts that we have at IDC. So on the left, this is from my colleagues that do enterprise infrastructure trackers. This is not, on the client itself. This is a measure of how many exabytes of data are going to be produced through enterprise infrastructure that are going towards data management workloads and technical workloads. And the reason I picked these two, data management is where a lot of our AI workloads are bucketed. Technical applications is a lot of where things like engineering, CAD, CAM, these things are bucketed. And we're prescribing 32% CAGR from 2020 to 2025, just incredible amount of growth. We think about all the goods and services being digitized outside of the tech industry. This is where a lot of those workloads are heading to. On the right, you see our workstation shipment forecast, the Dell Precisions, the Lenovo ThinkStations, things like that. And you can see in the same time period, we have it growing at 10% CAGR, which is actually pretty incredible when you consider it against the rest of the hardware and client market. And so this is important to me because, it doesn't matter if right now I'm talking about workstations, but again, this could be a proxy for a high end of any other market, right? If we were talking about consumers, I would be talking about gaming. It's great to me that we have at the highest end of the market, these things that are driving growth into it, because overall, that's how we drive long-term ASP growth. That's how we buttress some of the declines that we're going to feel in 23 and potentially in 24 as well. So, if we can get past sort of the harsh year that is going to be this year, I do believe we're going to get onto sort of a growth trajectory again in terms of the premium end of the market. And that should help a lot of us on the phone recover in faster ways. I'll go to the next slide. And I think since we're over time, I'll make this my last slide. This is sort of the same thing that I was talking about in terms of workstations, right? We have a lot of these very high-end workloads that are driving a significant amount of performance compute into the market. That's not just a commercial or B2B story. What you're looking at right now is our consumer survey data in the US, and we ask consumers, one, how old are you? But two, do you consider yourself a gamer? What kind of gamer? Do you consider yourself a content creator? And you can see, as we get younger and move into younger crowds, they're more likely to be gamers, core gamers, we would call them, hardcore enthusiast gamers. And you can see that same trend unfolding on the right in terms of content creators, albeit at a shorter clip, right? Or another way of thinking about it for me is perhaps the content creation market on the PC side is just 5-10 years behind what the gaming market is right now. And if we think about what the gaming market did in the last 5 years, that's going to be a very, very welcome, market driver into the consumer side of the market, which has been languishing pre-pandemic. So content creators, that whole ecosystem is huge now. They need better hardware, and they're going to drive, continued ASP growth on the consumer side of the market moving forward, the way that gaming has done in the last 5 years. So again, it's going to be tough in 23, but I think once we get to 24, not only will there be strong volume drivers that I talked about, but there will be strong ASP drivers as well, like I'm talking about right here. So I'll make that my last slide. There's another slide with the wall of text. This is just sort of our standard advice. Leave that to you to read. Thank you.
Thank you, Lynn. Thank you so much, Lynn. Lauren, just a couple of quick things, just housekeeping, just so everyone, because I got a lot of questions about it. Yes, this content will be available to you guys. Just want to thank again Lynn and Lauren and the IDC team for another fantastic presentation. A lot of great material here, things that you guys can take internally and use internally for your own analysis. Don't forget that if you have any questions about the offerings that IDC has, feel free to reach out to myself or to Frank or to Lauren and Lynn, and they can put you guys in touch with the right people. The other pieces you saw from Frank's presentation earlier, we do have our EMEA event coming up in June. If you're not the right person within your team to attend it, feel free to please share that. And also share the series with your teams. We have a pretty large database of contacts, but you guys know who within your teams would be interested. And more importantly, give us your feedback on the series of webinars. And if there is any special trend or category or topic you would like to see addressed here, and we'll make sure to coordinate together and provide that information for you on the next one. If anybody has any questions, let me know. And thank you again for joining us.